This is the current federal tax developments for the week of July the 13th, 2026. Current federal tax developments are brought to you by your state society of CPAs. I'm Ed Zollers, broadcasting and recording this week here in Phoenix, Arizona. We're going to cover a range of developments, including some procedural shifts, some post-Chevron litigation on a regulation, and some newly finalized regulations that affect some issues that we have. And our goal is to get beyond the basic news and explore some of the practical implications of what we're looking at. And this is our roadmap, shall we say, for the day. We have 9 primary topics this week. The IRS is getting busy here in this part of summer. There is a shift from the IRS regarding administrative penalty relief, and that's going to be moving from the legacy first time abatement, which is going to be disappearing, to the new automated AEP, automatic exemption from penalty options. We'll talk about what those impact and some of the issues on it. Next, we're going to cover the strict jurisdictional boundaries in the Court of Federal Claims found in the Savara case involving tax refund deadlines. After that, we're going to examine the taxpayer-friendly employee retention tax credit pleading in Mississippi. If you're thinking there's going to be any consistency in these district court rulings, you're going to be disappointed. So we're going to see yet another view on what would be a valid ERC claim. Then we're going to analyze the persistence of a New York convenience of the employer rule during the pandemic as we continue with the saga of Professor Zelensky. In the second half of this thing, we're going to take a look at the landmark Keysight Technology decision that invalidated a guilty anti-abuse regulation under the post-Chevron Loper-Bright standards of the Supreme Court. Going to discuss customer-funded leasehold improvements in the thermal circuits case, unpack the newly finalized 1035 exchange regulations in Treasury decision 10052, analyze the CRAT SPIA listed transaction rules found in Treasury decision 10051, and we're going to close with the National Taxpayers Advocate critical commentary on potential refunds of the topic we're starting with this. What are some of the downsides of the new AEP program, at least in the view of the Taxpayer Advocate? So we're going to begin with the first major topic. That's going to be the IRS's transition from traditional first-time abatement program to a new automatic exemption from penalty program that was announced on July 8th. And this is a significant administrative shift that's going to take a little while to come into place. Historically, practitioners and taxpayers have had to actually request first-time abatement, at least normally, though some report they have found that people have had to automatically apply. Now the IRS is seeking to make this automatic for everybody, right? So we're going to take a look at an overview of the transition, right? We're going to move our illustrations to the front this week. Again, these are available on the download. If you want to download from our website, the slides, they're there. If you're watching the video of this, you're seeing them right now. Now, the infographic here is just kind of a summary of where we're going. It's going to be on the left side, we see the manual request-bound nature of the legacy FTA, which required a formal telephone call, a written statement, or a Form 843 to trigger it for sure. It also allowed penalties and interest to accumulate during processing. On the right, we're going to see the new automated AEP system. The IRS aims to apply this relief seamlessly behind the scenes, issuing an automatic notice of confirmation. However, as shown in the center and bottom of the infographic, there are strict compliance histories and business rules, similar to what we have with FTA, broad exclusions for estate and gift tax returns, again, similar to FTA, and tactical traps regarding the statutory's reasonable cause defenses that you have to kind of look at potentially. So let's go with the core structural differences between the program we have now, first-time abatement, and the AEP. Under the legacy FTA system, the IRS would first assess the penalty. It set on the account and interest accumulated on both the tax and the penalty. The taxpayer or practitioner had to proactively identify eligibility and contact the IRS to request abatement. Generally, the issue there is that even though the Internal Revenue Manual essentially instructed IRS employees, if somebody's calling up about a penalty, to check to see if they had first-time abatement, there was nothing in the system that automatically said every penalty would be automatically checked for this. That was a key difference. With AEP, this relief is going to be integrated now directly into the original return processing system. If the system's business rules determine the taxpayer is eligible, the penalty is suppressed before assessment, meaning no penalty is ever assessed and no interest ever accrues or penalty accrues. The taxpayer will simply receive a notice confirming the relief was automatically granted. This will begin this summer, right now. We're in summer of 2026. It covers 2025 individual and corporate returns and 2026 quarterly filings, but it is an in-process system. We don't know for sure when it's going to be completed, except at least the notice implies that by the end of December, it will be automatic. So you're going to still be getting penalty notices that you may still need to call in and get FTA relief on. Okay. Now, why is the IRS making this switch? Broadly, it's about modernization and resource allocation. IRS CEO Frank Bisignano noted that this reflects the agency's commitment to making tax payments simpler and more consistent. Under the legacy system, a huge portion of taxpayers who would have qualified for FTA never received it because they didn't know it existed or couldn't get through to the IRS. By automating this program, the IRS ensures consistent, fair application across all qualifying demographics. Practically, it also clears IRS phone lines, which I think is the bigger issue for the IRS. Instead of hundreds of thousands of phone calls or Form 843 submissions for routine penalty abatements that are going to be granted per the IRM, the system handles it automatically, allowing the IRS customer service representation to focus on other non-automated issues. Okay. Now, it's critical, however, to note that AEP is not a universal remedy. The scope is strictly defined. It covers core compliance return series. And there's some inconsistency in what the IRS states here. And some practitioners have noted that there are returns that currently seem to get, first-time abatement that aren't listed in here. The actual penalty, the actual page describing the whole process here, administrative penalty relief, and now describing the new AEP program, says it covers form series for Form 1040 for individuals, 1065 for partnerships, 1120 for corporations, and the payroll unemployment series. So 940, 941, 943, 944, 945, and CT1. Now, this is where it gets more interesting. They also tell us it applies to standard failure to file penalties under 6651A1, partnerships failures under 6698A1, and S corporation failures under 6699A1. Now, hold that last one for just a second. Note, S corporations 1120S isn't listed under the forms that are going to be part of this program. That leads to the question, well, they didn't list it. Do they consider that in 1120? Which would seem weird because the code has two different penalties here. Or is the list wrong? Should they have not mentioned the S corporation penalty section? It's not really clear. We're going to have to figure out how they're going to go with this. And they also note it would cover failure to file or failure to pay under 6651A2 and A3 and failure to deposit rules under 6656. However, it does explicitly include information returns or returns filed only in response to specific transactions or infrequent events. Most notably, 706s and 709s are excluded. Now, the daily delinquency penalty and information reporting dependent on another filing are also completely outside the AEP program. Not going to get relief this way. You'll have to go another route. Now, here's the compliance history and business rules. To qualify for automatic AEP, the system applies a rigid clean history business rule, right? The taxpayer must have a clean history of compliance for the prior 3 years or 12 consecutive quarters for the exact same return type. For business taxpayers, the system has additional filters. Specifically, the business must not have had a failure to deposit penalty waived 4 or more times in the prior 3 years or 12 quarters. Furthermore, if a failure to deposit penalty was charged because the business was actively avoiding the EFTPS payment system, AEP is completely barred. If the client fails any of these systematic business rules, they are shut out of AEP. Their only option at that point is to file a manual request for relief under the traditional reasonable cause standards, which then will be manually reviewed by an IRS agent. Now, this clean history is going to come back. We talk about the National Taxpayers Advocate, who's going to look at this in combination with the automatic application and decide that, somebody might be automatically waived for a tiny penalty, and then a year later, accidentally trigger a big one. And unfortunately, they will have burned their AEP. Now, as I said, in theory, that should be true of FTA. You shouldn't be able to, if you're requesting relief and they qualify for FTA, the IRS employees have been generally instructed to provide FTA relief, automatically, and don't worry about the other item. But as noted here, if you have to call and ask for it, maybe just say, what, it's got a $10 penalty. I don't care. I'm paying it. And you wouldn't necessarily, we'd have to see what that is. It's like, well, you couldn't really pay it. You need to get it waived. So it's really weird about that. But at least some people had successfully gotten reasonable cause relief and not gotten FTA, avoided it. So that's one that's reported. It's inconsistent when I talk to practitioners. Now, as practitioners, you must manage this transition window pretty carefully. Although AEP applies to 2025 tax year returns and 2026 quarterly returns, the system rollout during the summer and fall of 2026 is going to be uneven, right? The IRS has warned that some qualifying taxpayers might still receive standard penalty notices for eligible 2025 and 2026 returns while the automated systems are being integrated. If a client receives an erroneous penalty notice during this transition, do not just assume the system will eventually catch up and fix it. You should be prepared to submit manual requests for legacy full, FTA, first time abatement, to ensure the penalty is abated. Manage your client's expectations also while the program is automatic. In theory, we may need to intervene manually during this initial rollout. And in fact, I'm going to assume I need to intervene manually until such time as we stop getting I never see one. That should have qualified for the first time for the AEP program. Then maybe I'll start believing we're not going to have that problem. Right now, a little tough to believe. Okay, next section, we're talking about strict enforcement of the tax refund statute of limitations. The case in this case is Schwarna versus United States, case number 25902T from the Federal Court of Claims, Court of Federal Claims, I should say. This was issued on July the 1st. So this covers a stark and tragic case of the Court of Federal Claims. In this case addresses the absolute rigidity of the statutory deadline for filing tax refund claims. It is an unyielding, high-stakes reminder for all of us that personal tragedies and caretaker distractions, no matter how sympathetic, cannot legally suspend the statute of limitations under Section 6511. So let's take a look at those jurisdictional rules first. Our graphic again. Right, this lays out the hard truth of the refund statute of limitation litigation. In the center is a ticking clock of the deadline. On the left, we see the statutory financial disability barrier under 6511H. To stop the clock temporarily, the law demands a medically determinable impairment of the taxpayers themselves, not a third party. On the right, we see the legal rules. Equitable tolling is completely unavailable at 6511. And before you start telling me about Culp and the Third Circuit, Culp specifically mentioned that while they were talking about the 90-day letter in tax court, they noted that if this was a district court filing and a suit for refund, there is no equitable tolling. So we're not yet seeing the courts finding any way of reading 6511 to make it equitable tolling. The court also found an amended return does not reset or restart the 3-year limitations window. Late claims frequently kill the court's jurisdiction. We're going to the district court or the Court of Federal Claims, resulting in the forfeiture of even highly valid, absolutely, there's no question the money's owed to the taxpayer overpayments. Like the $55,521 that was overpaid, that was lost by Mr. Savannah. Not great. Okay. So understand why the court was powerless to help the taxpayer in this case. You got to examine the jurisdictional prerequisite of tax refund litigation under the law. Under the Tucker Act, which is found in Title 28, United States Code, Section 1491A1, the United States has waived sovereign immunity for tax refund suits, but this waiver is very strictly conditional. First, under IRC Section 7422, bars any lawsuit until an administrative refund claim has been duly filed with the IRS, according to the tax law and regulations. And by the way, gang, there's a deadline on that, which is where we tend to run into our problems. Second, and most importantly, filing an administrative claim within the time limit, 6511A, is not just a defense the government can raise, it is a jurisdictional requirement. Even if the government doesn't raise the question, the court can. As Supreme Court held in United States versus Dahm in 1990, if the administrative claim was filed late, the federal courts lack subject matter jurisdiction and have no choice but to dismiss the suit. This is the concept of sovereign immunity. You have to meet the sovereign's requirements to be allowed to sue the sovereign, because you're not allowed to sue the king, right? Old English common law. The Federal Circuit recently confirmed in the 2025 BSTEC case that this rule remains absolutely binding. So we haven't had any changes due to the case law on the tax court. So let's take a look at the facts here. What do we have for facts in this case? During 2018 through 2020, Mr. Savannah's mother suffered from severe medical complications from multiple forms of cancer. He was her primary caretaker, demanding constant around-the-clock attention. Distracted by this crisis, he relied on H&R Block to file his 2018 return on April 15, 2019. This isn't somebody that didn't file his return. He did. But in September 2022, a few months after the statute for filing a claim for refund, H&R Block discovered a tax preparation error on his return. He had overpaid his 2018 taxes by over $53,000. Probably most of us would be like, I'd like to have $53,000, please. So he immediately filed an amended return on October 5th, 2022 to claim the refund. The IRS denied the claim as untimely because it was filed nearly 3.5 years after the original return, and we have a 3-year statute here. So that's a problem. And by the way, per the IRS, essentially, right, it's just legally barred. They can't accept it. The taxpayer filed a pro se suit. He represented himself in the Court of Federal Claims. Interestingly, the government initially tried to dismiss the suit as being 1 day late under the 2-year suit window of 6532A1. However, that's kind of a, well, okay, maybe, but it's like there's a much simpler way to get rid of this. The taxpayer, into that, pointed out he was actually timely. The final day fell on Memorial Day. Under Court Rule 61C, the deadline was extended to the next business day. So the government withdrew that objection, leaving the court to rule on the timeliness of the underlying administrative claim. And that's where the problem comes. Even though the IRS blew it, they went after the wrong deadline, and they got it wrong. Even though that's what they did, the court still had to figure out if they had jurisdiction. That's where you got a problem. Now, Mr. Savannah argued the 3-year statute of limitations should be suspended, basically under the financial disability exception of Section 6511H. Now, 6511H does suspend the clock if an individual is unable to manage their financial affairs due to a medically determinable physical or mental impairment. However, Chief Judge Salmonson emphasized the plain text of 6511H strictly requires the impairment be that of the taxpayer themselves. He was arguing his mother's illness was the issue. So his mother's illness was legally irrelevant, no matter how much it burdened him, right? He was being the good son. He was doing it. He wasn't, wasting tons of time going, detail by detail through his return for that year. He just assumed his tax preparer had prepared it correctly, right? The taxpayer's own pleadings, in fact, were fatal here. He admitted he was not personally disabled, but simply unable to manage affairs due to his mother's disability. This is one of the risks of being, quote, pro se. With representation, they might have considered looking to see if there could be some sort of medical argument made that the stress, etc., he was under rendered him essentially, unable due to mental impairment to properly manage his affairs. But, he didn't argue that. That was one of our problems. The court cited established precedent in the case, such as Murdoch, Brossi, McConey, and Placonis, right? Confirming around-the-clock caregiving of her terminally ill spouse or parent, while noble and exhausting, Yeah. Being a good person is legally insufficient to toll the statute. You're out of luck. So, unable to meet the strict terms of 6511B, the taxpayer pleaded with the court to apply the general principles of equitable tolling or fairness. But the court held that equitable tolling is categorically unavailable in 6511 refund cases. This is grounded in the landmark 1997 Supreme Court decision, United States versus Brokamp. In Broadcamp, I should say. In Broadcamp, Supreme Court explained 6511 is written in an incredibly detailed, highly technical, and non-discretionary manner that leaves no room for courts to read in implicit judicial exceptions. In fact, Congress specifically enacted 6511H, the financial disability provision, in response to the Broadcamp decision to create a very narrow, highly structured statutory exception for a taxpayer's own financial disability. Because Congress created that specific statutory pathway, it remains the exclusive path. The courts have absolutely no judicial discretion or equitable power to expand it. Life is unfair sometimes. Now, let's address a key technical distinction regarding amended returns. The taxpayer's original 28 routine return was filed on April 15, 2019, meaning his refund claim deadline was April 15, 2022. He filed his 1040X on October 5th, 2022. That was nearly 6 months late. The court rejected any notion that the amended return itself could restart the 3-year statute under 6511A. Citing Redondo and Cheney, Chief Judge noted that if filing an amended return reset the clock, the statute of limitations would be a dead letter. A taxpayer could simply file an amended return decades later to revive an expired claim. There's an interesting procedural note. The government actually made a technical error in its defense. It mistakenly assumed the amended return did restart the clock and conceded the timeliness. Instead, the government moved to dismiss our 6511B2 look-back rules, arguing that no taxes were paid in the 3 years preceding the claim. The court bypassed that and retired. The IRS was they totally missed the real issue. Totally. Because the court can rule on its own initiative for lack of jurisdiction. The lesson for us is clear. Sympathy is not going to be a substitute for strict compliance. When clients face major crises, we must immediately evaluate the need for any protective refund claims or extensions, things that might be happening. You got to realize that they can't get it for, caring for a parent. That doesn't work. Okay, let's move on now to the Region 4 Mental Health Services versus United States case. This is case number 3:26 CV12 RPC JMV from the Northern District Court of Mississippi, United States District Court, of course, on July 1st. So this is a continuation of the employee retention tax credit litigation, right? In this case, the district court in Mississippi addressed two very important procedural issues. First, where the IRS's refund and subsequent reassessment of an ERS claim extinguished the original claim and forced the taxpayer to start the administrative process over. And second, the level of specificity required in a complaint to survive a motion to dismiss when a pleading business suspension due to government orders, right? So let's look at the facts in this case, what happened both ways. Now, this is the illegal hurdles in this legislation per this court. On the left, we see the jurisdictional and statutory barriers. The taxpayers must meet threshold jurisdictional requirements. But the court strongly rejects the IRS's attempt to force a circular administrative claim process. It highlights the strict bar on seeking declaratory judgments due to the Anti-Injunction Act. On the right, the infographic focuses on pleading standards. The government has frequently tried to throw out taxpayer complaints in the initial stage by arguing they are shotgun pleadings that fail to link specific orders to specific business suspension. In this case, unlike others we have talked about in the past few weeks, the court rejected that complaint, right? It held that high specificity is not required at the initial complaint stage. Rather, proving the suspension is a fact-intensive process reserved for discovery. They're saying the fact they didn't list specific orders in their complaint, they didn't connect the dots, is not relevant. Though it was last week for one taxpayer. So, yeah, you can see. As I said, if you think we're going to get consistent results in these court cases on the ERC, you're going to be sadly disappointed. I think it's going to take these cases making their way to the Court of Claim, or I should say to the Court of Appeals in the various circuits before we may start to coalesce on what really matters. And of course, we're so late in the game that by the time we know what would have worked, it's be too late to actually file a claim under that theory. Okay, so let's look at the background. In October of 2022, Region for Mental Health Services, get the term out correctly, filed administrative refund claims totaling over $5.3 million for quarter 1, quarter 2, and quarter 3 of 2021. In June of 2023, the IRS approved and paid the quarter 2 portion, sending them nearly $2 million. However, after subsequent review, the IRS issued a letter in April 2024, disallowing claims for all 3 quarters, and issued a new assessment to claw back the $2 million Q2 refund. Well, in all the other cases we've talked about so far, what got the IRS to go after a previously issued refund was apparently the taxpayer filing in court, right, to challenge the disallowance. This is a case where they went back after it, even though the taxpayer hadn't yet filed anything in court about the other 2 quarters. Right? The taxpayer protested. The IRS denied the protest. The taxpayer filed a refund suit in district court. Taxpayer sought 2 things. First, a judgment for the refunds for the disallowed quarter 1 to quarter 3 credits, and secondly, a declaratory judgment they were entitled to retain the quarter 2 refund without penalty. Okay. So let's go this government's extinguished claim defense, right? The government filed a motion to dismiss the quarter 2 refund claim for lack of subject matter jurisdiction. Its argument was highly technical. They claimed that once they paid the quarter 2 refund in June 2023, the original administrative claim was completely extinguished. Therefore, when the IRS later disallowed the credit and issued a new assessment, it created a new tax liability. The IRS argued the taxpayer had to file a new administrative claim and wait for a new disallowance before they had a right to sue. The government relied on the case of Bilzerian and Wilkes, which prevented the IRS from resurrecting old tax assessment via erroneous refunds. But the court flatly rejected this circular logic. It noted that those cases addressed the IRS's power to assess tax, not a taxpayer's right to challenge a disallowance. The taxpayer had followed every procedural step, filing a claim, having it refunded, then disallowed, protesting, and having the protest denied. The court held that forcing the taxpayer to file a new administrative claim for an issue the IRS had already thoroughly audited and denied would be a complete and abject waste of time, would defy common sense, and is not required by law. And suffice it to say, the court was essentially telling the IRS, you're really pursuing this argument? And frankly, I'm kind of with the judge here. You're really pursuing this and trying to get out of here on that. So, nope, they said that doesn't work. Now, while the taxpayer won on a jurisdictional issue, they lost on a request for declaratory judgment. Taxpayers wanted the court to issue a declaration they could keep the quarter 2 refund cash. Government argued that this was barred by both the Declaratory Judgment Act and the Anti-Adjustment Act. The court agreed with the IRS on this point. Declaratory Judgment Act under Title 28 United States Code Section 2201A explicitly bars courts from issuing declaratory relief on federal tax controversies. Furthermore, the Anti-Injunction Act under Section 7421A, which strictly prohibits any lawsuit brought for the purpose of restraining the assessment or collection of any federal income tax, or federal tax, I should say. Therefore, the court dismissed the declaratory judgment claim. Takeaway here is procedural. A taxpayer cannot preemptively enjoin or declare away an IRS assessment. They have to proceed through the standard, rather painful litigation of a refund suit. Either pay the tax or sue for refund, or defend against collection in a standard refund forum. That's going to be their option. Okay. So finally, let's take a look at the government's shotgun pleading complaint. Right? So this is a pleading rule standard under Rule 12b-6. The government moved to dismiss the entire complaint, arguing it was a shotgun pleading because it didn't specify which government orders caused the suspension each quarter. The government cited the JMP restaurant case, where a court held a taxpayer must plead proximate cause with extreme specificity, showing exactly how a specific order caused specific shutdown. I told you, consistency is not what we're getting out of these courts. But this time, the court sided with the taxpayer, adopting more lenient and practical reasoning of the 2026 plastic film decision, another Mississippi decision. The court held that there is absolutely no requirement for such a high degree of specificity at the initial pleading stage. The complaint merely needs to put the government on notice of the claims. Proving whether the referenced government orders actually caused a full or partial suspension of operations is a highly fact-intensive issue. It is completely inappropriate to resolve this on a motion to dismiss. Rather, it is a matter reserved for discovery and summary judgment. Now, if you're facing shotgun pleading dismissals from the IRS, this is a, you know, positive case. But remember, we've seen courts, and this court even mentioned a court that said shotgun pleadings don't work. So you are playing a bit with fire with a shotgun pleading. Probably you want to name it. Now, that's going to get into a whole other argument, but at least until a circuit court's done it, it seems like that's risky to get your case dismissed and then hope your Circuit Court of Appeals will go ahead and reverse the dismissal. Again, nothing's gone to any Circuit Court of Appeals yet. Okay, our next item, fourth topic, is state taxation and the convenience of the employer rule. This is the case of the matter of Edward A. Zielinski et al. Versus Commissioner of Taxation and Finance of State of New York, New York case CV 251156, from New York Appellate Division, 3rd Department, and the opinion was issued on July 2nd of 2026. Now, in this case, the Appellate Division addressed a major pandemic era question. Did the state-mandated shutdowns of New York businesses during the COVID-19 turn a non-resident's remote work into an absolute necessity of the employer, thereby allowing them to allocate their income away from New York? So, by the way, if Zielinski sounds familiar, it's because Professor Zielinski was involved in a famous case back in the 90s, I believe. I believe it's back there now, where he challenged just the whole convenience of the employer rule overall in New York and lost. This time with COVID-19, he thought, well, come on, this one, they barred us from, they basically barred us from coming into the employer's site. That seems like I had to work from home for the convenience of the employer. But that's not how the court's going to read it. Okay. So again, our infographic is New York's remote work tax trap. The taxpayer's position, a Connecticut resident working under a public health mandate that closed the New York campus. He argued that the shutdown made remote work an absolute necessity of his employer. On the right, we see the court's rather rigid ruling. Because his employer was indifferent to where he delivered his Zoom lectures, he could have, gone ahead, driven to New York, had a portable Wi-Fi hotspot, and just parked out somewhere and, gave his Zoom lectures from inside the state of New York. They wouldn't have cared. Would have thought he was crazy, but they wouldn't have cared. The court ruled the work could be done anywhere and thus did not meet the high absolute necessity threshold. It was work that couldn't be done in the employer's office, but that didn't mean it had to be done outside of New York, which is a bit of an expansion of how far the convenience of the employer rules. The bottom panel covers the constitutional challenges. New York continues to win per this court on fair apportionment under this rule, and due process is satisfied through the taxpayer's ongoing institutional affiliation with a New York employer. Saying, we can get it. Now, let's look at the background of this case. The petitioner, Edward Zielinski, is a law professor at the Cardozo Law School in New York, but resides in Connecticut. In 2020, he worked on campus for 24 days, then COVID hit. On March 20th of 2020, Governor Cuomo issued Executive Order 202.8, which mandated that all non-essential businesses reduce their in-person workforce by 100% and telecommute to the maximum extent possible. As a result, Professor Zielinski performed all of his remaining 2020 duties, teaching classes, holding office hours, attending faculty meetings from his home in Connecticut. He filed his non-resident New York return allocating his income based on days worked in Connecticut and sought a refund of the New York withholdings for that reason, right? This wasn't his first time challenging the state, as I mentioned. He famously litigated, I guess it was back in 2003, not 1990s, in the first Zielinski case, when New York Court of Appeals held that his remote work days were fully taxable in the state of New York. And guess what? COVID didn't change that per the New York courts. So, to understand the court's decision, we're going to take a look at the New York Convenience of the Employer Rule framework. Under New York's tax law, non-residents are taxed on New York source income, which includes income from a trade, business, or occupation carried on in the state. Under New York's regulations at 20 NYCRR 132.18a, if a non-resident employee's duties are performed both inside and outside the state, they must allocate their income. However, the regulation establishes a convenience rule. Any day work outside of New York is treated as a New York workday unless the out-of-state work is performed due to the absolute necessity of the employer rather than for the convenience of the employee. This is what's called the convenience of the employer rule. As established in the Kitman and Spino cases, the strict policy behind this rule is to prevent non-residents gaining tax advantages that New York residents cannot access merely by choosing to work from home. Now, the fact that the nickname became convenience of the employer rule is what led many to believe that COVID-19 changed this, right? It was now not, the employer was not, saying, oh, we'll let you work from home. The employer was saying, look, we have no place to put you. Please work from home. But turns out, per the court, it doesn't matter. Now, the professor's core argument was the COVID-19 stay-at-home mandate changed everything. Like I said, convenience of the employer. Seems like we're working for the convenience of the employer from our home. Because the state ordered the law school to shut its physical campus, his employer could not provide him a place to work. Therefore, working from home is an absolute necessity of the employer, not his own convenience. However, the court rejected the argument. The court held the conveniences rule distinction between site-specific work and work that can be done from anywhere remains a rational and practical test. Although the governor's executive order shut down the campus, it did not mandate that Professor Zielinski work from Connecticut. Right? From the employer's perspective, Cardozo Law School was completely indifferent to where faculty delivered their Zoom lectures or conducted online meetings. They could have done that from an apartment in New York, a home in Connecticut, or anywhere else. The court concluded that temporary public health emergency, not employer necessity as legally defined, explained the remote work. Because the employer did not specifically require the services to be performed in Connecticut, the income remained fully taxable as New York source income. Now, the taxpayer also raised constitutional challenges under the Dormant Commerce Clause and Due Process Clause. On the Commerce Clause, the court reiterated that under the Huckabee precedent, non-residents' physical presence outside New York does not compel the state to allocate the income away. Non-residents do not engage in interstate commerce merely by telecommuting from home. Even if the Commerce Clause were triggered, the tax is fairly apportioned because the income is derived entirely from a New York employment. On the Due Process Clause, the court held the required minimum connection between the taxpayer and the taxing state was fully maintained. Professor Zielinski continued to derive significant tangible and intangible benefits from his New York employment, including his prestigious professional affiliation with a New York institution, research and scholarship support, and access to New York academic and legal communities. The court also brushed aside recent Supreme Court cases like Wynn and Mead West Vaco, weird name, distinguishing them as involving the apportionment of commercial, corporate, interstate activities rather than individual non-resident employment. The convenient rule survives the pandemic completely intact per New York courts. Now, obviously, the big question is, does Professor Zielinski want to take at least the constitutional challenges up to the U.S. Supreme Court or a higher court? We'll see if he stops here or keeps going this time. Okay, the fifth topic is a decision from the Court of Federal Claims, Keysight Technology versus United States. This is case number 25137 from the Court of Federal Claims, issued on July 2nd, 2026. This is one of the first major post-Chevron tax cases, and it provides a critical blueprint of how the federal courts will now scrutinize Treasury regulations that attempt to write anti-abuse rules without having specific statutory authority to do so. The court invalidated Treasury Regulation 1.951 Cap A-SUC5, which sought to deny amortization deductions on assets transferred during the guilty gap period. So let's look at the statutory gap that created this issue. Okay. So this infographic is going to illustrate the change in oversight, right? A change in administrative law after Chevron was overturned and we went to the Loper-Bright standard. The Keysight case is the primary case study. On the left, we see the guilty tax mismatch and Treasury's quote-unquote self-inflicted, weird way to phrase it, that's what the court did, regulatory fix, which denied a $500 million per year in amortization deductions by forcing them into a residual gross income bucket. On the right, we see the new post-Chevron judicial reality under Loper-Bright. agency interpretations receive absolutely no deference. And Section 7805 is not a blank check for the IRS to rewrite clear statutory text. At the bottom, we see the factual relationship standard wins. Amortization deductions must follow the assets that generate the income. 7805 had been used by the Supreme Court in an earlier case, to essentially say, yeah, all regulations are legislative, fundamentally. This is a court saying, no, we really think Loper-Bright has changed that theory, that 7805A doesn't just automatically let the IRS write whatever they want in interpreting regulation. So, to understand Keysight, we must look at the guilty gap period mismatch. In 2017, the Tax Cuts and Jobs Act created the Global Intangible Low Tax Income Regime under Section 951 Cap A. However, because the effective date chosen by Congress, there was an inconsistency in treatment between fiscal year and calendar year controlled foreign corporations. Fiscal year CFCs had a gap period or disqualified period before guilty provisions officially applied to them. Taxpayers realized they could engage in tax-free intercompany transfers of highly appreciated intangible assets from a fiscal year CFC to a calendar year CFC during this gap period. This transaction generated a massive, stepped-up, disqualified basis in the hands of the receiving calendar year CFC, but triggered zero immediate tax liability. The stepped-up basis could then be amortized over 15 years, reducing the CFC's future taxable income. We found a loophole. Okay. Now, Treasury viewed this gap period step-up as an abusive loophole, and they promulgated Treasury Regulation 1.951 Cap A-2C5 as a, per the court, self-inflicted fix. The regulation did not deny the basis step-up itself. Instead, it manipulated the expense allocation rules. It forced any depreciation and amortization deductions attributable to this disqualified basis to be allocated in portions solely to residual CFC gross income, which is gross income other than guilty tested income or subpart F income. By forcing the deductions into this residual bucket, the IRS effectively made the amortization completely useless, preventing it from reducing the CFC's guilty income. Keysight Technologies, a multinational tech provider, challenged this regulation in a refund suit, seeking to claim $50 million in annual Section 197 amortization deductions from 2020 through 2033. Because there were no disputed facts, the case was decided as pure question of law on cross motions for summary judgment. So, this is where we're going to see at the post-Chevron judicial review framework, using Loper, Bright, and Skidmore standards. Okay. So, we're applying this case. You remember Loper, Bright Enterprises versus Raimondo, which officially overruled the Chevron doctrine. Under the old Chevron doctrine, if a tax statute was ambiguous, right, the law did not clearly explain something, courts would defer to any reasonable IRS interpretation reviewed under the much weaker Skidmore standard, where the agency's review is merely right? Forget that. You just restate that. In this case, there is deference, right? Reasonable interpretations. However, under Loper Bright, that is gone. The deference is gone. The courts have a final exclusive authority to interpret statutes using the standards of, statutory construction. Agency interpretations are now reviewed on the much weaker Skidmore standard, where the agency's view is merely persuasive based on the thoroughness of its consideration, the validity of its reasoning, and its consistency over time. Under the Administrative Procedures Act, under Title V, Section United States Code, Section 706, the courts must set aside any regulation that exceeds statutory jurisdiction or is not in accordance with the law. As Judge Tapp noted, the IRS can no longer simply declare a statute ambiguous and rewrite it to fit their policy goals. Kind of, a bolt from above, shall we say, at least from the Court of Federal Claims at this point. We'll see if the IRS appeals this to the Federal Circuit, if the Federal Circuit, backs up the Court of Federal Claims here, because that's really when we're going to find out about this. Now, to defend the regulation, the government relied on the general grant of rulemaking authority under 7805A, which allows the Secretary to prescribe all needful rules and regulations. The government argued that this general authority gave the IRS the power to issue anti-abuse rules to block transactions that contradicted unexpressed congressional intent. Okay. Now, like I said, the Supreme Court had accepted that, but in a case ruled before, they reversed things in Loper Bright. And this court strongly rejected that argument now post Loper Bright. It held that 7508A is not a blank check. If 7508A allowed the IRS to define when a rule is needful and to write clear statutory provisions, it would completely bypass and validate Loper Bright. The court also noted the IRS's shifting statutory justification. In the proposed rules, they relied on their specific anti-abuse authority under Section 951A(d)(4). But in the final rule, they pivoted to 7805(a). The court pointed out why. 951A(d)(4) strictly grants authority to issue anti-abuse rules for this subsection, which refers to subsection D regarding qualified business asset investment calculations, QBAI. It does not grant any authority to write anti-abuse rules for subsection C regarding tested income. The IRS was caught trying to save a narrow QBI anti-abuse provision, to use that to rewrite the entire tested income regime. And can't do that one. So they pivoted at the last moment. Next, the government tried to argue that because 951 Cap AC references subtracting deductions properly allocable under rules similar to rules of Section 954B5 and implicitly delegate authority to the IRS to define properly allocable. Court rejected this, noting that the subsection C does not mention the Secretary or delegate rulemaking power at all. Under established Supreme Court precedent, congressional silence is a treacherous guide to intent, especially since Congress explicitly delegated regulatory authority in other subsections of 951A, but not in subsection C. So, what is the ordinary meaning of properly allocable? Citing the Savage case, the court determined it means expenses that are factually related to generating, the corresponding income. Under standard 861 allocation rules, deductions are allocated based on this factual relationship test. If an asset is used in activity generates guilty gross tested income, the amortization on asset is factually related and properly allocable to that income. The Treasury's attempt to force factually related deductions into a residual, non-guilty category had no statutory basis and was ruled completely invalid. The planning takeaway here is massive, if somewhat limited, among most of our clients. Practitioners immediately review corporate clients' guilty filings for open years and file protective refund claims if they were forced to allocate amortization and depreciation deductions to residual CFC gross income under this invalidated regulation. My guess is you also could have an argument, even on change of accounting method, that you're being prevented from do this, if you weren't amortizing it, that it may have been an improper, use. And we'll just kind of see. I don't think that last one's going to work, but I can see where people could try it. Okay. Next, this is a critical supply chain financing and tax characterization case from the tax court in the case of Thermal Circuit Inc. versus Commissioner, Tax Court Moran decision 2026-29, decided on July 7th. This case addresses a scenario where a primary customer funds leasehold improvements at a manufacturing facility to secure increased production capacity. The key issue is, are these funded improvements treated as a tax-free, non-shareholder contribution to capital under Section 118, or must they be characterized as taxable compensation, meaning income to the corporation? So let's take a look at our infographic. This is the $4.3 million manufacturer expansion trap analyzed by the tax court. In the center, we see a balancing scale. On the left is the taxpayer argument for tax-free capital contribution. On the right is the reality. The transaction was characterized as taxable compensation. The key details here are highlighted. The court applied the Grote and McKay ownership litmus test to find a manufacturer owned the improvements, creating a taxable accession to wealth. It also shows the customer fund improvements are barred from capital contribution treatment by Section 118B itself, just automatically. And critically, at the bottom left, we see the saving grace. While the taxpayer lost on tax income, 20% accuracy penalty was completely vacated due to what the court found was reasonable contract-based good faith. So, what were the facts in this case? Thermal Circuits is a C corporation that manufactures specialized foil heating components. In 2016, their primary customer, Nico Ventures Trading Limited, NVT, wanted to dramatically increase its order volume. To do so without driving up per unit costs, NVT agreed to fund a major expansion of Thermal's leased manufacturing facility. NVT provided $4.3 million over 2017 and 2018 to fund leasehold improvements, which included an etching room, a dark room, an extra office, and manufacturing space. On its 2017 and 2018 corporate returns, Thermal did not report the $4.3 million as income instead treating it as a tax-free non-shareholder contribution to capital under Section 118A. Consistently, Thermal did not claim any depreciation deductions on these improvements. Thermal's position was that NVT held equitable title to the improvements and that Thermal merely held legal title as a matter of convenience under their manufacturing contract. Now we take a look at who is the real owner. This is the Grote and McKay, issue, right? This issue, who actually owned them, is the key for tax purposes. Thermal argued that NVT held equitable title, while the IRS argued Thermal owned them. To resolve this, the court applied the multi-factor test from the landmark Grote and McKay case. The court looked at who bore the benefits and burdens of ownership. That evidence heavily favored the IRS. Thermal paid the property insurance and property taxes for the entire premises, bore all risks of possession, held the certificate of occupancy in its own name. Because Thermal could not prove that NVT had beneficial ownership, the court ruled that the improvements belonged to Thermal. Under Section 61A in the classic Supreme Court Glensaw Glass gross income case is construed broadly to include all accessions to wealth clearly realized over which the taxpayer have complete dominion. Receiving $4.3 million worth of brand new permanent facility improvements for free was a clear accession to wealth that made it taxable income under the law. Now, since Thermal owned the improvements, the next question was, did they qualify for the exclusion as a contribution to capital under 118A? This is a corporation-only statute, and it used to be argued quite often by corporations. But we're now going to apply the five-part test from Supreme Court Chicago, Burlington, and Quincy Railroad case. The transaction failed the second prong, which requires that a capital contribution not be compensation for specific quantifiable services. The evidence showed NVT has conducted a thorough cost-benefit analysis and calculated they would fully recoup their $4.3 million investment by buying a specific large volume of 4 oil heaters from Thermal at a reduced per unit price. Because the payments were directly linked to securing goods at a lower price, they were characterized as taxable compensation. Furthermore, 118 changed a couple years back, right? The court noted even this transaction did look like capital contribution, it was completely blocked by Section 118B1. So 118B1 explicitly excludes any contribution made by a customer or potential customer or in aid of construction from tax-free capital treatment. Since NVT was a customer and funds were used for construction, inclusion in gross income was mandatory. Under the standard accrual rules, the income was recognized in the year the funds were received, $4.085 billion in 2017 and $240,000 in 2018. Now for the good news for thermal circuits. The IRS sought to impose a 20% aggravated penalty under Section 6662A for a substantial understatement of tax. Thermal asserted a defense of reasonable cause and good faith under 6664C. The court applied the standard from Neonatology Associates, asking whether Thermal exercised ordinary business care and prudence. The tax court agreed that Thermal's mistake was entirely reasonable under the circumstances. The draft agreements between the parties were highly ambiguous, utilizing terms like NVT property and dedicated equipment in ways that led Thermal to honestly believe NVT held legal or equitable ownership of the improvements. Furthermore, Thermal's conduct was completely consistent with this honest belief. They used the expanded facility strictly for NVT's orders and actively sought releases from NVT when they wanted to use the space for other clients, and consistently refrained from claiming depreciation deductions on their tax returns. Because Thermal acted with honest intent and relied on reasonable interpretations of highly complex and ambiguous contracts, the court vacated the entire 20% aggravated penalty. So this is helpful precedent, when somebody just misinterprets a contract. You can show it was reasonable and good faith misinterpretation. Our seventh topic covers the newly finalized regulations under Treasury Decision 10052, published on July 9, 2026. These regulations address the transfer for value rules under Section 101 and information reporting under Section 6050 Cap-wide, adopting with major practitioner-friendly revisions the proposed regulations that were put out a couple of years back in Reg 108054-21. This trade decision represents an enormous victory for tax professionals and wealth planners as it permanently dismantles an inadvertent tax trap that threatened to make ordinary, tax-free 1035 life insurance contracts taxable. Let's look at this whole background. Now, this infographic does basically show us how the final regulation successfully disarmed the 1035 trap. In the center, we see the 1035 tax trap being sprung open, allowing life insurance policies to pass through safely. Left side highlights the automatic carryover tax attributes. If the policy was untainted before, it remains untainted. If it had RPS taint, the taint carries over directly to the prevent tax washing. Crucially, it highlights retroactive protection back to December 31st, 2017. On the right, the infographic details the elimination of the administrative burdens of Form 1099 SB and outlines the new 5% de minimis gross asset exceptions for corporate mergers. So let's walk through that technical trap that got introduced accidentally in 2019. Generally, life insurance death benefits are income tax-free benefits under Section 101A of the Code. However, under the transfer of value rule, if a policy is transferred for consideration, the tax exclusion is capped at the purchase price plus subsequent premiums. The 2017 Tax Cuts and Jobs Act added reportable policy sales rules, which strip away transfer for value exception if policy is acquired by investors. To implement the TCJ, the IRS issued regulations in 2019 in Treasury Decision 9879. But those regulations contained a severe drafting error. Form Regulations Section 1.101-1E2 defined a transfer to include the issuance of a policy in exchange pursuant to Section 1035. Because surrendering an old policy for a new one is a transfer for valuable consideration, standard 1035 exchanges triggered the transfer for value rule. To escape tax, the exchange had to fit the carryover base exception under 101A2 Cap A. But that exception is strictly limited to transfer basis property, where a base is determined by reference to the transferor's basis. A 1035 exchange results in exchange basis property determined by the taxpayer's own basis in the surrender policy, not somebody else's. Because this technical mismatch, the carryover exception was unavailable, right? Meaning a standard routine 1035 exchange of an untainted policy risks making the entire death benefit fully taxable. The IRS admitted this was entirely unintended and issued the proposed regs to fix it. Now, to solve this, TD 10052, right, implements a coordinated 4-point framework. First, they amended Regulation 1.101-1E2 to explicitly confirm that mere issuance of a policy in 1035 exchange is not a transfer. So this removes stranded, untainted 1035 contracts, exchanges from transfer value rules. Secondly, they added Regulation 1.101-1B2IV to establish an attribute carryover system. If the old policy was 100% tax-free, the new policy is 100% tax-free. If the old policy was tainted by a previously transfer for value implementation, that taint's carried over. The excludable death benefit of the new policy is limited to what would be excludable under the old policy, plus any subsequent premiums paid. Third, Regulation 1.101-1C3 carries over any reportable policy stale status. This blocks a loophole where an investor attempts to wash an RPS tainted policy by exchanging it for a new one. Fourth, the final regulations clarify treatment of boot, cash received, in 1035 exchange under Regulation 1.101-1B2 IVB. The excludable proceeds are carried over are decreased by the tax-free boot received and increased by any gain recognized on the exchange, mirroring standard basis adjustments. Now let's look at the administrative reporting victory and change. In the 2023 proposed regulations, the IRS plan to force both insurance companies involved in 1035 exchange to file Form 1099 SB with the IRS and furnish statements to the policyholder. The insurance industry strongly objected, pointing out that carriers already exchanged cost-based policy details informally without IRS forms, that adding Form 1099 SB would be a massive duplicative burden. The IRS agreed and completely eliminated the Form 1099 SB filing requirements for 1035 exchanges. Instead, they added Regulation 1.6050 Cap Y-3H, which establishes a simplified carrier-to-carrier notice requirement. Only when an old policy has an RPS taint must the old carrier transmit the relevant tax attributes and cost basis directly to the new carrier. Furthermore, they can do so using any reasonable method, allowing them to utilize standard industry exchange of information forms. To keep track of these transactions, the IRS anticipates adding a new distribution code in Box 7 of Form 1099-R to identify tax-free exchange of an RPS tainted contract once that form is updated. Another major victory in TD 10052 involves corporate-owned life insurance in mergers and acquisitions. Under 2819 rules, if corporate-owned life insurance was acquired indirectly via stock reorganization, it was exempt from the reportable policy sales if the life insurance made up 50% or less of the corporate's assets. However, the exact same COLI policies were transferred directly in asset reorganization, such as an A merger under Section 368A1 Cap A. The transaction was treated as a direct acquisition and did not benefit from the 50% threshold, potentially triggering an accidental reportable policy sale and taxing the death benefits. To eliminate this disparate treatment, the final regulations add a new de minimis exception under Regulation 1.101-1C2V. A direct transfer of a corporate-owned life insurance from one C Corp to another C Corp in a Section 368A merger is exempt from any RPS rules. If first, both parties are parties to the reorganization; second, the target conducts an active trade or business; and third, neither party is in the business of investing in life insurance; and fourth, the COLI policies represent 5% or less of the gross asset value of the targets before and the acquirer after the transaction. The IRS declined to expand this into S corporations partnerships for taxable asset sales, but has invited public comment for future expansions. Let's look at the effective dates now, because they're relatively favorable. While the regulations are formally effective on July 9th of 2026, the IRS has provided a massive planning opportunity. Taxpayers may elect to apply the new substantive rules retroactively to all exchanges and acquisitions occurring after December 31st, 2017. Potentially a huge deal if you're affected by it. It allows us to review all client files for Section 1035 exchanges executed since 2017. If any clients undertook 1035 exchanges under the shadow of 2019 regulations, worried about potential transfer for value tax exposures, we can make an immediate election to apply these regulations retroactively, fully protecting their tax-free death benefits. For corporate transactions, we must also update our checklist to ensure that we run a quick gross asset value calculation in a target company holding COLI policies to ensure they fall under the 5% threshold before executing a direct asset reorganization. Next up, our eighth topic. We definitely have quite a few this week, as you've noticed, right? This is Treasury Decision 10051, another set of regs published alongside Treasury Decision 10052 on July 9th. This regulation finalizes the proposed rules from Regulation 108-761-22, which formally reclassifies specific tax avoidance schemes using charitable remainder annuity trusts and single premium immediate annuities, so CRATs, CRTs, and SPIAs, right, as listed transactions or tax shelters. We have had a lot of discussion about this, both when the IRS issued the first CCA saying we think this is abusive, to the proposed regs, and now the regs have been finalized. So this does change things because now they are listed transactions, and they are, the IRS has moved to expand that list. So we have again our, infographic, which is entitled "Cracking the CRAT," right? And this is the anatomy of this shelter. The top panel shows mechanical steps. The claimed basis step-up mirage, and the shell game played with the SPIA. In essence, following by the misapplication of the Section 72 annuity rules. In the center, we have a clear table comparing the abusive distribution treatment under Section 72 with the proper legally required application of the Section 664 tier rules, which tax distributions as ordinary income and capital gain. The bottom panel outlines the severe enforcement penalties, including a 6-year look back for material advisors, massive non-disclosure fines under Section 6707A, and important, any client that's gotten involved in any of these is going to have to make some compliance, disclosures for existing structures will come up on October 7th of this year. So the clock's running. Okay, first let's look at the procedural background of this listing, which is a bit fascinating. Historically, the IRS identified tax shelters and listed transactions through notices or bulletins. However, in recent years, tax controversy litigation has dealt a pretty big blow to this practice. In cases like Mann Construction, Green Valley, Green Rock, and GBX Associates, federal courts held that identifying listed transactions via subrogatory notices violated the Administrative Procedures Act because the IRS failed to go through the mandatory notice and comment rulemaking process. To save its enforcement capabilities, the IRS made a strategic pivot. They're going to the regs now. And in this case, they finalized Reg TD, or the final Treasury decision, TD 10051 through formal notice of consent rulemaking. So the IRS has insulated this listing from challenges under the APA, at least under this method. This represents a permanently rather stable regulatory foundation, allows the IRS to aggressively proceed these transactions and enforce disclosure obligations without being thrown out of court on a procedural technicality. They threw in the towel. Okay, so let's break down the exact mechanical steps that target this transaction. And you'll see there are 5 steps on your screen, right? So promoters say, this is it. These 5 steps is why you're going to pay very, very little tax. First, the grantor establishes a purported CRAT under Section 664, right? The grantor transfers highly appreciated property to the trust. So far, this seems very vanilla, right? Now, here's where it gets weird, though. In that second step, the promoter claims there's a basis step up under Section 1012. But here's the problem. It's a gift. That's not inherited. Therefore, it gets a carryover basis under 1015, right? It's under the gift rules in this case. Third, the trustee sells the property tax-free. Since the trust is tax-exempt, okay, that one's good. That's fine. Fourth, the trustee uses the entire sales cash to purchase a single premium immediate annuity. Now remember, because they said there was a basis step up, step 3 would generate no capital gain. Except it does, right? Then they purchase this annuity, because this annuity is important for this too, right? And so, and it's really weird because supposedly if we had no gain there, then, why do we need this other part? Yeah, basically, you're going to put it inside annuity, and then we're going to limit the taxation of it, sort of kind of work around it, but still invest it, etc. We'll get to what's going here. The SPIA, right, okay, here's the abuse. The SPIA pays the trust, and the trust distributed to the beneficiary, right? The beneficiary treats distribution as tax-free recovery of investment under Section 72, completely ignoring the mandatory trust distribution tiers under 664B, and therefore shields millions, potentially, in capital gains from tax. They're only paying tax on the ordinary income generated by the SPIA, and only as the SPIA pushes that out, a lot of which will be greatly deferred, on their annuity payments they make. Seems like a perfect situation, right? Okay. Well, the IRS's technical position is the beneficiary is not the owner of the SPIA, because they aren't. The SPIA is an asset of the trust issued in the name of the trust. Okay, that's the way it is. Therefore, any payments from the SPIA that ends up going to the beneficiary must follow the strict statutory hierarchy of Section 664B trust distribution tier rules. Under these rules, distribution must first be treated as ordinary income to the extent of the trust's current accumulated ordinary income tier 1. Okay, that much is currently being taxed under either theory, right? Because the SPIA is going to kick out ordinary income to the trust. But where the problem comes in, every other dollar is almost certainly going to need to be taxed as a distribution of capital gains to the extent of their cumulative capital gains in Tier 2, which includes that huge capital gain, which was the whole thing we're trying to dodge. Okay. That's triggered when the trustee sold the appreciated asset. Third is other income, Tier 3. Only after Tiers 1, 2, or 3 are fully exhausted can a cash distribution be treated as tax-free corpus, Tier 4. By misapplying Section 72, the promoters attempt to bypass the tiers entirely, which is a statutory violation. Further, the IRS noted many of these structures contain structural flaws, such as greater of annuity clauses or early cash buyouts of the charity for a nominal fee, which automatically disqualify the trust CRAT status under 664 D1C because the entire remainder interest is not actually transferred to the charity. Now, how a CRAT would really work? Step 1, as I said, you do that, right? We form a CRAT. We contribute property to the CRAT, right? We then, then we sell that appreciated property, which creates a capital gain tier. We don't pay tax on it immediately because it is a tax-exempt trust. But now we suddenly have that whole, tier level of income that's going to have to be fully absorbed before we can get to a return of basis. And then we pay out a certain percentage. It's a CRAT, so we're paying out a percentage of what we put in to begin with each year. And, that's going to be coming out probably over the term of the trust, assuming that we didn't have really low basis asset we put in there, which is then why did we do the CRAT? We're going to essentially be picking up the ordinary income each year from the annuity, and we're going to be picking up then the rest of what would be the annuity principal, that came to the trust, and it's coming out to us as capital gain income. So while we would defer paying tax on capital gain, and we get a charitable contribution deduction, based on present value concepts, we don't totally skip the capital gain. This is trying to have your cake and eat it too. And with the low dollar value buyout, they may even try to make sure that in essence, really doesn't really cost you anything. Which, yeah, let's just say it costs you very little except the promoter's fee. This is now a listed transaction. And that means not only transactions that are exactly like this, but transactions that are very similar to this. Yeah, the similar rule means that if you get somebody who says, oh, no, this isn't us because, see, we modify step 4 by doing some quirky little different things that really makes no difference. No. If it looks like this in general, it is a listed transaction. Don't buy it because I guarantee you some promoters were going to try to save it. And I don't mean save it about whether it works or not. No, it doesn't really work, but let's presume it did. You could still have something that works, but it'll still be a listed transaction because it went through this process. And failing to report it's going to get you penalized. Doesn't mean failing to treat it the way the IRS says treat it's going to, cause a problem if you actually prevail, which you won't, but let's ignore that for now. But yeah, so again, tell your client, I don't care. And I don't care if they do think they can defend it perfectly. They can't defend it's not a listed transaction. That I will tell you right off. That one's a loser. You're going to lose that. And so you need to disclose it. And of course, they don't want it disclosed. Right? That'll be the background. Now, since these have become officially listed transactions, what exactly are the obligations imposed on taxpayers? For participants, the grantors and beneficiaries, the requirements are immediate and severe. They must disclose a petition on Form 8886 attached to their return and send a copy to the Office of Tax Shelter Analysis, OTSA. Failure to disclose on any return that this has been claimed on triggers a mandatory penalty under Section 6707A equal to 70% of the tax benefit, capped at $100,000 for individuals, $200,000 for entities. And remember, since you're reporting the wrong income every year is going to have to be disclosed. Right? Furthermore, any actual understatements under 662 Cap A are increased to a flat, non-waivable 30% if the transaction was not disclosed. No reasonable cause relief. Most importantly, the statute of limitations under Section 6501C10 remains open indefinitely. The IRS come auditing years or decades later, and the clock won't start ticking to 1 year after you finally file that form. And this form does have to be filed for previously filed returns if they were engaged in this. If the statute of limitations is still open. For any client entering into one of these transactions in an open year, we've got to do our disclosure by August 7th, 2026, 90 days from July 9th date. So that's the catch. Any transaction that was still open on July 9th, you must file a disclosure form by October 7th, or that statute is not expiring. Yeah, so be aware of that. Okay. The regulations also target material advisors, which includes CPAs, attorneys, and promoters who receive fees meeting the statutory thresholds, $10,000 if the beneficiary is a natural person, $25,000 otherwise. Material advisors must file Form 8918 to get a reportable transaction number and are required to maintain detailed investor lists under Section 601112. Most alarmingly, the final regulation contained a 6-year look-back provision. If an advisor made a tax statement endorsing or describing tax benefits of this CRAT SBI structure on or after July 9, 2020, they're required to disclose. As clarified, it merely explaining general compliant CRAT tax rules is not a tax statement. But if you endorse the abusive Section 72 tax recovery interpretation, you are a material advisor. Failure to comply triggers massive daily penalties under Section 6707 and 6708, which accumulate at $10,000 per day. There's a helpful safe harbor. Charities named as remainder beneficiaries are completely exempt from disclosure and excise penalties under Section 4965, provided they not actively promote the scheme. So you got to take a look at your files immediately for any clients that utilize these structures, and did you give them advice related to it? Because then you get into material advisor role. Probably given the IRS focus on this, I might be a little concerned about my liability too, and might want to check with some legal counsel about how things could play out. Okay, finally, we're in our final update for the week. And this is the National Taxpayer Advocate's perspective on AEP. This is from the National Taxpayer Advocate's blog online, entitled Long Awaited Taxpayer When the IRS Implements Automatic Reply Relief. It was published on July 8th of 2026, right? So this is a detailed commentary on the rollout. While the National Taxpayer Advocate hails AEP as a massive victory for taxpayer equity, she also raises a very serious technical warning regarding how this automated administrative waiver might inadvertently trap taxpayers and strip away their statutory right to reasonable cause relief. And why that's a problem because of how AEP operates. Right? So let's look at NTA scale analysis first, right? This issue. This provides a deep dive analysis of AEP. At the center, we see the massive scale of the automatic penalty relief revolution, a 7 times increased number of taxpayers receiving relief. From the right side, details administrative trap and the risk of future eligibility jeopardy. If the automated system applies AEP to a year where a taxpayer actually had a valid statutory reasonable cause defense, it unnecessarily exhausts their clean compliance history. And this has been a complaint under FTA as well. Okay. If you call the IRS and they actually noticed you qualified for FTA, and they just apply that and don't consider reasonable cause, which they were basically told to do, then you just burned it. And it might have been a $5 penalty, but you just burned it. And because you just burned it, if the next year, let's say it was a failure to file penalty, there was some minor reason for why it happened, etc. They had reasonable cause. They were hospitalized. You're in a car accident on their way to mail the return, or to do it, post it, and they were, hospitalized, etc., unconscious, and nobody knew they were taking the return. Nobody had the return. The return got lost at the accident scene, and so it wasn't filed until 3 days later. Well, that's reasonable cause. But because you could qualify for FTA, IRS may very well have just applied FTA. That meant the next year, if you really did just foul up and you failed to get it filed, and let's say the failure this time was on the CPA firm, because CPA firm failed to transmit the return after they had the authorization, or they failed to notice it was rejected until a year later when somebody finally said, hey guys, it's been, hey guys, we're missing your return, then yeah, we have a problem. So, that second one would be fully applied. And because you can't have reasonable cause under Boyle for your CPA or EA forgetting to file your return, well, that's just tough luck. Yeah, check Boyle. It's pretty clear. Well, and how courts have interpreted Boyle now in the electronic filing age. So let's talk about our nice little infographic here, right? This is a major taxpayer win in a program like we said. Oh, okay. Wait, we're back on the main slide. That's right. So this is a major taxpayer win in a program that she has actively advocated for several years. The legacy manual system for FTA relief was highly inequitable. Many taxpayers legally qualified for penalty abatement never received it simply because they didn't know it existed, didn't understand how to request it, couldn't get through the IRS on the phone, or didn't have the money to hire a CPA, EA, or attorney to advise them. By integrating AEP directly into the return process, the IRS removes those barriers and equalizes access. The scale of this change is staggering. Your 2025 alone, the IRS processed manual FTA relief for approximately 220,000 taxpayers. The Taxpayer Advocate estimates that if automated program had been active in fiscal year 2025, over 1.5 million taxpayers would have automatically received relief, representing a 7-fold increase in taxpayer assistance. Right? So generally good for taxpayers, right? Now she is going to raise this issue, which, as I said, existed in FTA as well. Okay. Right? AP, like FTA's administrative waiver, it is a discretionary program created by the IRS. It is not statutory relief. Statutory relief is, for instance, reasonable cause under Section 6651, which is a right established by Congress. Because AP is automated, the IRS system will apply AP automatically upon processing. Previously, it probably would go ahead and apply it the minute you called up and the person on the line noticed you qualified for FTA. In either case, create an equitable displacement statutory right. Right? So, like I said, we imagine this client has a medical emergency that clearly qualifies as reasonable cause for late filing. Our system doesn't know that. It simply sees a late return, check the prior 3 years of clean, and says good. By automatically clearing that, the IRS has exhausted the client's clean compliance history. If the client faces a failure in the next 3 years, and then, before the 3-year period is up, let's say in 2027, as I said, the CPA or EA or attorney forgets to transmit the return. They're completely barred from the system because the system treats 2025 AAP as having used up their clean history. They lose a future waiver because the IRS used an administrative shortcut to displace their statutory right to reasonable cause. The result is fundamentally unfair and undermines congressional intent, per the taxpayer advocate. Now, she actually, when this is under consideration, was telling them they need to allow for administrative waivers. The IRS intentionally did not allow it in this program. So understand, this is a decision of the IRS. So to address the risk, the National Taxpayer Advocate has made several formal recommendations to the IRS. First, she recommends the IRS establish a substitution safe harbor, allowing practitioners to submit a reasonable cause claim and substitute on a taxpayer's account for automatic AP relief. This will retroactively restore the taxpayer's clean compliance history and prefer their future eligibility for AEP if a compliant taxpayer who is penalized in early 2026, in essence, basically penalties down the road. Secondly, she suggested that to ease the transition rollout, the IRS should apply AEP retroactively to any compliant taxpayers who were penalized in early 2026 before the automated program becomes fully active. Third, she urges the IRS to create a robust, transparent FAQ page so taxpayers and practitioners can clearly understand these rules. Now, we need to remain vigilant for now. We have to monitor our clients' accounts. If the IRS automatically applies AEP to a client who has valid statutory reasonable cause, we might want to protest and request the IRS record the reasonable cause. The only problem is we're only going to know they got it because they send us that letter, which, I was listening to a CPE course yesterday, and, as the person presenting said, there is this file that the client will walk in with that just had her name on it, Mary, tax stuff. And all of those unopened letters from the IRS will be in there. And you'll have to go through those to find it. That's assuming they actually bring it, right? Otherwise, you have these clients that, just, well, look, it says I'm not being penalized. There was no harm, no foul. If I send it to Mary, she's going to charge me for this. So I'm just not going to send it. Yeah, it makes it kind of fun. But you want to let clients know if that happens, still let me know you got it, because it might be a very minor penalty. And once they do this, you're going to have to maintain a 3-year clean history before you can use it again, which means if this year you had absolutely clear reasonable cause for, late filing, we might want to try to raise some concerns with the IRS and maybe your Congress critter's office, to, say, no, go back and record that as reasonable cause. Because again, per these rules, if it was dismissed for waived for reasonable cause, that doesn't count against the 3-year period. But yeah, and like I say, because we know that a failure in electronic filing, which could happen to any firm, right, and probably has happened to most firms at some point, something didn't get filed on time. Now, if you were lucky, it wasn't really terribly relevant, but it's happened to most everybody. There is no waiver. So if that return had a big balance due, it'd be really bad to lose the automatic waiver on that. Certainly really bad for us too as a CPA or EA. Over a $5 penalty that was waived the previous year, which the client had absolute clear, reasonable basis. So that's it. Well, this is the end of our week's updates for current federal tax developments. We got a lot of things happened this week, as you notice. So, keep your mind up. We're talking about automated penalty relief, post Chevron invalidation of Treasury regulation, the caretaker limitation of tax refund statutes, all those other things we saw this week. We need to kind of make sure we keep things open, understand what's happening. I want to thank you for tuning in today. Remember, if you have any questions, my email address on the final slide, edzollers@currentfederaltaxdevelopments.com, right? And also, if you are a member of the Arizona Society of CPAs, New Jersey Society, Idaho Society, Illinois Society, Washington Society of CPAs, on their Connect sites, and you post questions there, and I see them, I'll see if I can answer them. I see again this week, I got the slide date wrong. It should be July 20th. So hopefully we're good with that. But otherwise, thank you for being here this week, and we'll see you next week on Current Federal Tax Developments.